You guys know better than I do how important financing is for agriculture. These aren't small projects. These aren't projects with 4 or 5 or 6 numbers. They've got a lot more zeros than that. And a producer, a business person, they can't do these deals on their own. They need a partner. And the great partners for years in South Dakota have been those ag lenders that have helped us get from here to there. And the panel that we've got up here today are folks who really do know how to make investment in South Dakota happen. The first person we've got is Nate Franzen. Last night I called him the Franzen machine, and he is well known to plenty of folks. I'm not going to read his bio, but you know, I will raise up the one thing he's been very involved with has been at South Dakota Ag and Rural Leadership Association, and he was in that first class, and he's been head of the Alumni Association, and he's been helping to build that human capital that we all recognize we need within the agricultural arena. The second participant we've got is Bob Rutten, and when you look at Bob's resume, one thing jumps out at you. Aside from all of the great business expertise, it's community involvement. He's been the head of so many different organizations in Arlington, they've actually had to invent more. He's run out of all of the ones that he can help build a better Arlington. And we know when we look at the rural communities, where's the leadership coming from? Where are the people who are helping to make those communities strong? And it is folks in the ag sector. There's no question about that. Bob Rutten is a good example. Bob Schmidt, Farm Credit Services, Senior Vice President for this area of the country. And it's a hard worker. Last night at dinner we were talking about how much sandbagging he'd had to do around the Farm Credit building there in Fort Pierre. How much sandbagging he'd had to do around his own home, around his own neighborhood. And he applies that same incredible work ethic to his work, like so many folks on the road 2-3 times a week. And that work ethic is a big reason for Bob's success. Next, we've got Steve Dutenhoffer, Regional President of Dakota Bank. And this guy really understands the link between success in the ag industry and building a smart agricultural workforce. You look at his involvement with the Lake Area Technical Institute, and that bond, that link, comes screaming off that page. Ladies and gentlemen, before we get started, let's give a round of applause to our panelists here. So what we're going to do is we're going to try to tackle 4 areas here. I'm going to ask a question to one of these 4 gentlemen. They're going to be the main respondent, but then the other panelists are going to get an opportunity to chime in. Tell us all where that first fellow was wrong. And then we're going to open it up, question by question basis, to the folks out in the audience. So it'll sort of be 4 mini panels within this panel. And we're going to go ahead and get started. Now the first question is going to be for Nate, and it's going to deal with land values. Everybody knows the incredible appreciation that we've seen in land values for quite a number of years. And let's go ahead and kick that off to you. I mean, help us understand that. Does it make sense?
Thank you, Dusty. What our panel did is put together a handout for you, and we may refer to it from time to time. I probably won't refer to specific slides, but I hope you find that as a useful tool to take home with you and maybe even jot some notes down as we talk. I'm going to just touch on some land value issues and where I see things, and we hope to field lots of questions from all of you as this progresses. You've maybe heard it said that agriculture today it's kind of like Silicon Valley was during the computer boom. It's now Silicon Prairie, and ag is one of the shining stars in our general economy. And land value trends have certainly reflected that. And if you look at any of those graphs in those handouts, you can see the increased values in land values. And we all know the discussion, whether it's $10,000 or $14,000 an acre ground in northwest Iowa, or $4,600 dollar acre ground in south of Wetumpka, South Dakota. No matter where you look, those land values are going up very strong. And what I'd like to do is just touch on some things that I think are driving that, and then talk a bit about maybe what the outlook might be from my perspective at least. Certainly margins and profits in production agriculture drive land values. 75% of the land purchases out there are from ag farmers and producers, and lots of times we talk about the investment influence, the investor influence. I can tell you in the last 2 years in particular, It's ag producers making the large majority of those purchases. And they're able to do that when profits are strong, when margins are strong, like they have been the last few years. So what factors can come into that? Obviously commodity prices. And you've heard folks refer to our commodity prices the last few years as a super cycle. Is it really a super cycle? How long is it here? Those are the things that I think will impact land values very significantly going forward. If we stay in a high commodity price environment, we'll see strong support for land values. If something happens to change that, certainly that could change the equation. Part of profits and margins, of course, is on the expense side of the equation. So input costs are a big influence on land values. And one of the biggest drivers of that in agriculture, we all know, is oil and energy. 70 to 80% of any farm operations costs are driven by energy costs. The cost of oil, the cost of energy, fertilizer, chemical, it's all intertwined. You couple that with technology advancement and production efficiencies, and I know our panel this afternoon is going to dive a lot deeper into those things, but those are game changers that are making farmers more efficient, making our operations more profitable and more margin, especially in these commodity price times. What are some things that could change that? Question I would pose to you, does anybody remember what LDP is? Loan deficiency payments? A couple people, right? It's easy for us to forget. It's been a while since we've been there. When do you think the last time we had LDP prices was? Actually, for corn, it was September 2006, and soybeans was a month later, October 2006. It wasn't all that long ago, 5 years ago. And so could we go back there again? I'm not predicting we will, but certainly we could. And some of the things that I think could drive that could be taxation, these regulations that are continually becoming more and more costly, changes in the Farm Bill, those type of things could have significant impacts on our commodity prices going forward. Another key driver to land values is global population trends. I think our Secretary of Ag mentioned it at the onset. There's more and more people on the planet. I think roughly 6.5 billion today and projected to grow another 3 to 4 billion over the next 20 years. That's significant. That's a lot of new mouths on this planet to feed, and who's going to feed them? And the land values we have need to sustain that. As we talk about population growth, just as important, or maybe even more important, is the ability for that population to afford food and to be able to pay for a reasonable price for our ag products. And that's where the economic conditions really play in, and folks entering the middle class. One of the interesting things that I try to follow and track is what's going on in China and India and places like that, developing countries where there's just tremendous amount of population growth, and currently, at least in China and India particularly, strong GDP growth, strong economic growth. Those economies are growing, and if they continue to do that, they're going to add significant people to the middle class. And once you enter the middle class, you want to eat better. You want to upgrade your quality of food. And the numbers that I most recently saw today, they project about 400 million folks in China and India considered to be in the middle class. That's projected to go to 1.2 billion. So take it times 3 over the next 15 years if they stay on the same economic growth trend they're on today. Those are significant game changers for demand for our product, and those kind of things, if they work out favorably, are really going to provide a tremendous floor to prices and continue to put a floor under land values. Interest rates, which I'm not going to touch on much because we'll talk about it in more depth here in a little bit, but interest rates, the tremendously low interest rates today are obviously influencing land values to some degree as well. That interest expense when you're financing a land purchase is as low as it's ever been. Investment alternatives are also a real factor today. With a weak general economy, with ag being the shining star, lots of investors look at ag land as one of the best investments our economy is offering today. And so it has an impact. And then just the fact that, you know, land is a finite resource. There's only so much productive ag land on this planet. And that productive land needs to feed a growing population and a growing middle class. Very important factors on land values to think about. The thing we talk about all the time at First Dakota is we need to think globally but act locally. And agriculture is so much affected on a global market, on a global basis. We all need to understand that and try to keep up with those trends, but at the same time make local decisions that make sense for our operation, for our banks, for our communities that we serve. So I'm going to stop there. I hit the highlights on things that I think are impacting land values, and I look forward to trying to field your questions.
Well, let's pop into the panel real quick. I mean, who wants to go first?
I have a comment.
Yeah, go ahead, Bob.
Over the last 6, 8 months or even longer, there's been a lot of questions that people have asked us. You know, are we going to be in the next real estate bubble? And considering it the home problems that they've had. And my response has been this. We may be somewhat of a valuation bubble, but we're not in a credit bubble. And those are two distinct differences. And what I mean by that is we have maybe overheated in some valuation in some areas. I know we had 2 recent sales in Northwest Iowa that are over 13,000. We've got some sales in South Dakota that continue to increase. In the last 10 years, we've had a 231% increase in real estate values in South Dakota. So our valuations in South Dakota have been as strong as anywhere in the upper Midwest. But what makes me feel good about things is from a credit perspective, we didn't chase this. We have not decided to not chase this real estate market like we did maybe in the 80s. Unfortunately, I was around in the 80s, and we did chase that real estate market, and probably more than we should have. And we've got sustainable value models that we have in play that restrain our lending levels. We find that other industry leaders do the same thing. So we put somewhat, if you call it, caps on the amount that we will lend, which reduces the exposure, which requires that producer to either put in more capital or put in more real estate. And for example, our average real estate loan level last year, based on our appraisal, not on selling price, was 53%. So there can be significant volatility in the real estate valuation, but our credit that we've displayed out to our customers is such that they're in a situation that they have the ability to, from a normal income level, to make those payments and continue to survive. So we feel good about where we, as an entire industry in South Dakota, the lenders are lending, I think, at a reasonable rate. We're trying to follow the real estate market as close as we can and put in the right lending constraints, if you will, but yet still try to assist the producer as best that we're able to. So if we see a pullback in valuation, we don't think that it's going to have a significant impact on the credit piece of that producer. So to me, there's two distinct things. We could see some valuation if, like Nate talked about, with interest rates sliding back or commodity prices sliding back. They're going to impact potential real estate valuations. And if they do, we feel good about our portfolio from a credit perspective that it's not going to cause panic in the industry and with our producers in South Dakota.
Yeah, Bob?
I echo that with the idea that the balance sheets are stronger with the people that are doing the financing. We did not have that last time we had an ag crisis, and I also agree it's not going to be an ag bubble. You know, we had dot-com bubbles in the residential real estate bubble, but the last time we had that crisis, we were financing land, and we had some very inventive programs to finance the land to get the young people on the land. Contract for deed holders, you know, 50% of the interest income was tax exempt. Banks, every state had a young farmer program. And a few years ago, they coined a term that in the housing market that was called subprime lending. Well, that's what was happening years ago. We just didn't know it. Yeah. It was just poor underwriting. But in South Dakota, we have an advantage over some of the other ag states too that, you know, right now, as Nate said, most of the land is being bought by producers. The investors, as this land value goes up, the capitalization rate goes down. It's not as appealing with this run-up in values. But we also have people that are still looking for a piece of earth, finite resource. And these people may still buy land in South Dakota without worrying about the return. All they want is a place to go. And no matter where you go in South Dakota and buy a piece of land, you're going to be very close to hunting, fishing, other recreational opportunities. So I think that will help us sustain that. Otherwise, the land values are propped up by commodity prices and interest rates. And we'll talk about the interest rates in a little bit, but commodity prices is the other driver. It's not the cash rent. It's not the cash rent.
Nate?
Dusty, the only other thing I would add, if you look on those land value trends and those charts, in the 80s when we toppled, and both Bob Schmidt and Bob Rutten have covered that very well, and the reasons for that. Lots of things were different at that point in time. That crash was severe, and any of us that remember that, lived through that, recognize and remember how hard that was. Something that jumps off the page to me when we look back in history on that is from the peak in about 1984 to when we crashed until we got back again to what that 1984 land value level was, it's about an 18-year period. It was about an 18-year correction in land values. I don't think any of us see that happening again because it's not a credit bubble this time. Could be an asset bubble, as Bob mentioned, and the one key thing I think about on an asset bubble doesn't mean we're not immune to land values falling. Certainly things could happen to create that, but farmers and ranchers, the owners of that land, are in a better position to withstand some of that volatility this time. And so hopefully that's a positive to the long-term viability of our industry.
So, I mean, you guys don't feel like you're chasing the market too much. I mean, you feel like your portfolio is pretty well balanced, but can you say that about all the banking interests in South Dakota? I mean, you guys are squared away, but is everybody?
I think these guys can answer that, but what we run into when we talk to, when we're looking at a deal and there's other banks that are looking at it, we're hearing that they have some kind of limit as well. So that makes us feel good. And so that's what we're hearing.
Bob Rutten mentioned subprime lending, one of the big problems in the mortgage crisis that hit us a few years ago. I don't know of a lender out there that's making subprime ag loans. I'm not familiar with that happening, and that's a good thing for our industry.
The only thing we have seen lately is ag has been very good for a few years, and we're starting to attract the wrong attention. There are some players in our market that weren't here before, and they won't be as soon as there's a correction. But they're after ag loans, especially real estate.
Just for reference, both these individuals have talked about it, but 73% last year of all purchases were done by existing producers. So you got 3/4 of the individuals, and they're using their working capital and they're using their earnings to capitalize the new purchase. So the investor market has slowed significantly. The other players in the industry have slowed. So it's our producers that are primarily purchasing the existing farm ground.
So, Bob, when you talk about folks who maybe shouldn't be in the market and won't be after a correction, I mean, who are you talking about? Not necessarily names, but give me an idea of the...
There's, large credit companies, where right now there isn't anything out there to lend to that has a decent return. There's less risk out here in ag than there is in commercial real estate or some of the other things that they were investing in 10 years ago.
Now, Steve, when you heard Nate's presentation and he talked about some things that, could potentially negatively impact, land values, which of those keep you up at night?
Which of those would keep me up at night? Oh, there's a number of them. But primarily, really what I wanted to comment a little bit more on, Dusty, was the investors that were in the market that perhaps drove it at one point in time. In some cases, are actually exiting the market. They've seen opportunity to take some profit. They're actually exiting the market. So, and it is producers that are now purchasing the land again.
So now is that exit happening at a rate that's healthy? I mean, you don't just want a massive pull out. I mean,
no,
are they sort of slowly phasing out?
Yes, they are.
Okay.
As the stock market has come back, as there are alternative things to invest in, that's where that capitalization rate gets pressure.
So the question that I threw out to Steve, I'll throw out to all of you. I mean, which of those factors do you think are the biggest threat to land values, to sort of the new normal we've settled in at?
Well, there's no question that rising rates are going to have significant impact, and probably the one that's coming at us fairly soon. So rising rates are going to impact the cap rate that we're talking about. It's going to impact lots of things around real estate. So we could see some retraction with valuations as real estate rates start to rise.
Go ahead, Bob and then Steve.
But rising interest rates and perhaps the changing commodity prices, that's certainly driving it right now.
Right.
Now, the commodity prices will fluctuate. When interest rate changes, it's going to be changed for a long time. And that's our next step.
Well, yeah, I suppose that's right.
The other point that Nate made very well was that the game is now margins. You know, we can have commodity prices. They're going to be very volatile, and expect them to be volatile. But the key is the margin, and the margin is what's going to be able to drive the capacity piece. So as rates or as commodity values move up and down, which they will, the key then is to understand your cost side so you can determine your margins, and your margins is what's be able to determine the amount of profit that you generate that determines the amount of capacity that you have. So,
sure. Rutten had mentioned interest rates, and we probably should segue that direction. But first, let's go ahead and throw it out to the crowd here. Now, who's got mics out there? Lucas Lunch over there's got mics.
Yeah, Dusty, I've got a mic. And gentlemen, if you wouldn't mind, just pick the mics up or hold them a little closer for more clarity out here in the audience with the acoustics. There are recipe cards on the tables. If you don't have any, you can put your hand up and we'll get some to you. If you have a specific question you'd like to use the mic for, you're welcome to do that, or write them down as well. Are there any questions from the audience this morning?
And we'll give you another opportunity at the end, but if somebody wants to bore in a little bit on land values, this would be the best time to do it.
All right.
We'll go ahead and give them, Luke, maybe we'll give them a minute to sort of get a feel, write some questions, and we'll move to interest rates. And then at the end of the interest rates discussion, we can come back and pick up questions. Make sense, Lucas?
Yes, thank you.
Okay, sounds good. Let's go ahead and hear Bob Rutten talk to us a little bit about interest rates, and sort of specifically, I mean, for producers out there, or for folks who are partnering with producers, how should they be dealing with the cost of production increasing along with the interest rates, and sort of the interplay between those?
Right now, we're all aware that we're in an interest rate environment that is historically low, not by rate, but by duration. Since December 16th of 2008, Fed funds have been between 0 and 0.25. The Fed has kept their policy of keeping rates low for an extended period of time for quite a while. But we all know that if you study rate cycles, that as rates go up or down, they usually do it at the same pace or frequency. And the last time when rates were brought down in 2008, there was several changes very fast, and we bottomed out. And people talked about, at that time, is this going to be a V curve? Are we going to go down and then go back up again right away? Is it going to be a U with a little flat bottom? Was there a double dip recession ahead of us where we'd have a W form? But what we ended up with was this long period of low rates. And when rates go back up, I feel there will be that same length of time at the upper level. And these rate cycles have 5-year lives. And if we look back just as recently as June of 2011, we had a flat yield curve. A 3-month Treasury or security was 5.25%, and a 30-year was just a hair over 5%. And at that time, if we as a bank wanted to make an investment and we bought a bond, and we have some, in fact, one rolled off yesterday that was 5.25, that was bought 5 years ago. And as it rolled off yesterday, if we wanted to reinvest that same amount of money, the $500,000, what was out there was over 350 basis points less than what we were earning the day before. So when we look at that, if we have a chance to finance a farm operation or a land deal, that rate of return is a lot better than what we're getting in that investment portfolio. The this question on how is this going to affect the rising rates, and right now Fed funds futures trade the probability of a rate increase. Now right now the probability of a rate increase is out there in May of 2012. 2 years ago we thought there was going to be a rate increase in the second half, fourth quarter of 2010. Last year they talked about that happening this year. Right now we're looking at May of 2012 with the most probability of a rate increase, and that sounds like a whole year from now. And it also is in the middle of the second quarter of 2012. So we should enjoy this rate for a while. But when we end up having to pay off the country's debt, when the government gets out of the quantitative easing 1 and 2 program they had where they helped artificially keep rates low for a long time, when they have to get the debt paid off, we're going to be competing with the government for funds. Right now, our source of funds are very inexpensive. When that happens, that rate will be passed on to the customer. And we did some scenarios yesterday on just a regular customer that if they would have had 3% higher this spring when we set up their financing, the difference on their operating loan would have been, difference was between $10,612 and $17,000. They said, well, that makes a lot of difference on the size of the operating loan, and that's assuming that the loan is going to be fully funded for, at least 9 months. But the point is, you divide that by the number of acres that they cover. Now that's another so many dollars per acre more than it was before. But the term debt would have gone from $39,900 to $60,266. And the point was, the 3% rise in what they were getting would have been a rate they would have died for 5 years ago. They would have thought that was a heck of a deal. If it goes up from 4.75 to 7.75, that's still a good rate in history. In our bank, we looked at, if we took just the variable rate loans that we have on our system right now, not touch the loans that were in a fixed rate scenario, $310,000 difference for our income on just the operating loans that were on a variable rate, and that averaged out $1,188 more per loan. And some of the loans are a lot larger than others. But the other thing to remember for that producer is if his bank rate or his lender's rate is going up and increases his cost of production, so has the interest rate for the fuel dealer, the seed corn producer, and all of the other companies that are financing. And I think that to me, your question was, what keeps you up at night? What keeps me up at night more than any of this is interest rates and our lack of being able to control them when they do turn around.
Let's get some response to that from the other panelists. Thoughts?
Bob covered it very well. A couple of things I always think about is inflation's going to drive our short-term rates. And, today, certainly our general economy is so weak that it's hard to imagine we're going to see inflation soon. We're in such a dynamic market and environment right now, though things can happen to change that quicker than they used to. But with our housing crisis still very much in play and all the high unemployment, the low GDP growth that we're experiencing as a country, it's hard to imagine our inflation's going to kick in real quickly. The QE2, the other thing that's coming up is actually July 1. In 2 days, it's a pretty significant date. QE2 ends, and the Fed has told us that. So they're going to quit pumping that liquidity into the market. Now, they have said they're going to renew maturities, so at least they're not going to pull back a lot of liquidity, but they're going to quit pumping liquidity into the market. And you're hearing some noise out there amongst economists saying that that could create our first big tick up in interest rates. I don't know if that'll happen or not. Time will tell, but we should know here in the next few weeks what at least the initial reaction to QE2 stopping will have.
Just a short comment. Can you hear me okay? On one thing that makes us feel good about things is on the real estate side, at least, around 80% of our portfolio is fixed. And they've taken advantage of some really good rates that Bob talked about over the last couple years. And so that's a fixed cost that's in play on an annual basis. So that's something that from a risk management standpoint, we're glad to see. And our producers we encourage them to lock in those rates, and we have encouraged them to lock in rates, and they've done that. And they've locked in some very good rates over a long period of time, which should help them weather some ups and downs in the industry.
And I was just going to add to that too, Dusty, the fact that we're going to be talking about risk management here shortly, and that's one thing our producers are doing. They're going out there, they're seeking these opportunities, they're locking these rates in, and it's certainly going to help them going forward.
So what, Bob, you mentioned that interest rates may get to the upper level. What do you envision that being? I mean, there's no crystal ball, and other people will be put on the hot spot too, but how high is high?
Like I say, if we get back to where, for a bank or a lender to take on an ag credit risk, you're going to be back to that 4.5% spread over what the treasuries are. Then we're looking at that 8.5 type area again, not necessarily for real estate, but for operating.
So is he wrong, guys?
Well, I'll give you the economist answer, and then Bob's going to tell us all exactly where it's going to go. The economists would tell you that optimal for our economy is somewhere in that 7 to 9% range. And if you look back on historical averages, that's historically what interest rates have averaged. So hopefully, if the Fed's doing a good job and Bernanke's controlling the pedal the right way, we'll trend towards that range and then stay there. And if we do that, the economists will tell us that that's a healthy range. That's where we need to be. Today it's unhealthy to be as low as we are, even though it's been a real boost and a help for heavy credit users as they make some of these purchases. Go ahead and tell us where they're going.
I don't have any idea where they're going to go. But I do know this, that all of us up here have been lending money for a long time, and we've not seen rates at this level. So they're going to go up. And what that number settles in at, I have no idea, but it's going to be something north of where we're at today. And we can just manage that risk as we move forward.
Anything to add, Steve? Okay. So we just got done in sort of the last conversation talking about how most producers really, it seems like they're managing their credit well, they're not overextended. And yet doesn't part of you get a little nervous when you look at, okay, so we talk about inflation showing up, that increases production costs at the same time that would drive interest rates higher. I mean, producers end up, as they so often do one way or another, getting pinched from two sides. I mean, you think there's enough health and resiliency within the industry to be able to withstand that?
Right now, I think there is. Like I say, it's not the same scenarios we had before.
I would just say that from a statistical standpoint, our average working capital, which is liquidity, in our balance sheets is significantly greater than it was years past. Their overall debt is typically less, and they're more proactive. What we see is conversations around different enterprises within their production as to which ones are more profitable than others, and spending the time and energy to enhance that profitability in a particular enterprise within their operation, and spending either liquidating the one that isn't or doing something that's enhancing the one that is. So we're seeing the producer being more sophisticated, they're more proactive in their farming practices, they're more proactive in their risk management, and therefore it enhances their overall balance sheet.
And that's one thing, the customers are more sophisticated. And another thing, They just saw what happened to their city brethren across the country a few years ago. And a lot of them are going to make darn sure they don't get in that situation because they all know it could happen.
So do we see that kind of strength along the entire ag industry continuum? I mean, we've been talking quite a little bit about producers. If they're in good shape, is that also true for, you know, ag-based businesses, ag processing? Is there the same kind of strength there?
I would say generally yes, but certainly there's pockets where margins haven't been as favorable. And even within the producer realms, you know, it wasn't very long ago, and margins in the swine industry were very, very tight, and red ink. Dairy, you know, dairy is also another segment where it's not been quite as strong here in recent times. So it's not across the board always, but I would agree with what they've said. As we've tracked our portfolios, as we monitor the health and condition of our customers, I've told our staff this, we need to take pictures of some of these charts and graphs and things that we're managing, because we probably won't see this again. Our producers have had some tremendous opportunity to be profitable. And, you know, back to your question of what keeps you up at night, probably the thing that keeps me up more than anything is, and I can't say that I'm seeing it at widespread, so it probably shouldn't keep me up at night, but just the complacency that might come out there. You know, things have been good for 2-3 years in a row, maybe even longer in some instances. Earnings have been good, and boy, we don't want to be complacent with that. We want to use that opportunity to prepare ourselves for what could be tough times ahead.
Yeah, one other thought I've got before we throw it out to the crowd here, but you know, Bob Rutten mentioned that, you know, when the government starts to pay off the debt, and I mean, I chuckle a little bit when you said that. I mean, because although I think that's a source of great debate in Washington, D.C., I mean, are we really seeing movement that way? I mean, I think a certain number of skeptical folks believe that, you know, that'll happen when, you know, unicorns are running the United States Senate. Thoughts?
I'll tell you this, if we don't get that figured out, we've got real risk of interest rates skyrocketing, because as soon as other countries aren't comfortable investing in us, we'll see real problems in long-term interest rates, and those rates will pop more than is healthy. And so, although politically it's hard for them to make any traction today, and it sure doesn't look like they're going to get there, you know, we're gonna have a day of reckoning here, and we better get it right.
They will raise the debt ceiling, and they will cut programs. They have to. That's a mandate. And then that cost of reducing this debt. You look at Greece right now. If you want to be an investor, you can buy short-term bonds in Greece for 28% interest. That's a heck of a return. You may not get your interest and you may not get your principal back, but that's a heck of a rate. I don't think the U.S. government will default on their bonds, but they're going to have to pay up.
Hey, Dusty, from the audience, one of the questions that came up was around the interest rates. What do you see happening in the ag economy when interest rates begin to increase, and specifically around operating capital?
I'll take a quick stab at that. One thing to bear in mind, interest rates are significantly, especially on our operating capital. So they could move 20, you know, when you look at it on a cost per acre, it isn't really, I don't want to minimize it, but it isn't maybe as much as what you have some fertilizer, some seed costs, and some other costs per acre that you need to provide risk management around. So because of where they're at, and if they would move 25 or 30% on our operating capital, that may not have that significant of an impact on the overall net margins of the operation. Not that they don't need to be cognizant of it, they should be. But it may not have that kind of impact if it goes from 5 to 6%. So while we need to watch it and be in tune with what the markets are doing, we also have to equally be in tune with other input costs that are associated with production agriculture that impact the overall net margins in that operation.
I'll make a comment that you know, every one of us in this room ought to hope rates go to about 8%. And I know some of you that are paying 4% on your operating note today are saying, what's he talking about? He's crazy. But if it does that, it means this economy is finally getting on its feet. You know, it means the general economy is finally showing some signs of health. And we talk about how we get our national debt resolved. We talk about how we deal with a lot of other issues. a healthy general economy goes a long ways to making a lot of things better. So, you know, I would say we all ought to be hoping for rates to go up to a more normal, healthy level, because that's a sign our economy is getting back on track.
Another thing, when the ag sector has it bad or has a recession, we got less than 2% of the people affected, and we have to solve our own problems. But when the other 98% of the population gets into a recession, there's all kinds of programs to try to turn the recession around. And when this economy does come back, and it will, and it's going to be good, but it's going to be at our expense. We let them out of the recession, but that's when we're going to be paying more. That's when our commodity prices are going to be less. I mean, that's not.
Dusty, I was just going to follow up a little bit on Bob's comment with regard to interest, and if interest does go up, you know, if you look at these balance sheets or you look at these projections, the interest expense is probably one of the smaller expenses right now when you compare it to fertilizer, chemical. Look what your land rent values are doing. That's what's really affecting the bottom lines, the margins of these operations right now. Can interest expense go up? Yeah, it can, but it won't do what we've seen in the cash rents and the fertilizer and the input costs. So
There's room for an increase, and it isn't going to break the operation.
Well said. Other questions?
We also have a question on the first question of the day regarding land values. Yesterday during the Key Leader Roundtable, topic came up about the impact of value-added projects. And question around land values is, for example, is a dividend from value-added projects such as ethanol being paid in the form of higher land values?
You know, I go back to what I talked about on demand. You know, to me, demand drives prices, demand drives land values in the end. And is ethanol a part of that? Absolutely. A third of our corn crop. So is it a factor? You bet it's a factor. Is it the only factor? Absolutely not. There's lots of other things impacting demand, and it's all part of that big equation on what's happening from a demand side.
And when we first got into ethanol here, we were very fortunate at that time, you know, like you say, Silicon Valley. This ethanol thing was for part of our state. And the people that got in it in the beginning did get a very good return. And a lot of that was reinvested in land without debt. A lot of those people took that windfall and straightened out their house. And that's helping them survive now.
Another question regarding to ag processing, just a general question. How important is increasing ag processing in South Dakota to the banking industry?
Very important. I wish we had more. I wish we could do more. You know, when you talk value add, you know, anytime we can take any of our products, a commodity or a smaller item, and turn it around, add some value to it, process it in the state, that's a windfall. There's room for a lot more processing. I wish we could.
If you take the existing throughput and just keep moving it up the chain, and it stays within the state of South Dakota, and each operation has the ability to take a piece of that, that can only be a positive impact to the state.
We don't have to look very far. We can kind of look to some of our neighbors. You know, we talked about Northwest Iowa. You look at there's a pocket in Northwest Iowa where they've figured that out. They're doing it in a big way, and it's got a major impact on those communities right there. Nebraska has several areas where you can look to things that they've done that's really enhanced their ag economy, and we could learn a lot from that.
Are there particular things, Nate and others, that those parts of our region have done to better position themselves to have that success?
It goes back to zoning, you know, local control over what you can build. You know, it's hard to put anything that has, you know, a larger animal unit or some kind of a processing plant when we can't get it permitted and located where we need to. You look down there, every crossroad, you look north and south, and you see shiny rooftops of hog buildings, and it's amazing. They can be a 1.5 mile apart, and people live with it. We can't get that same attitude here.
Do we have other questions, Lucas,
we
for
do.
now?
We have a question from the audience.
Thank you. Bill Even with Pioneer. This question plays off something that Nate had mentioned earlier about the growing global awareness of the need for resources for countries to care for their population. And I've become aware that there are nation states, either with large populations or that lack their ability to feed their population. They are embarking on global farmland acquisition programs, either outright buying farm ground or securing upwards of 90-year leases or 99-year leases for farm ground. And for example, South Korea, China, Saudi Arabia, a number of the countries in the Middle East that have a lot of oil wealth but their inability to feed themselves. I was on a panel discussion last summer with representatives of the Kingdom of Saudi Arabia, and they were actively embarking on a research program looking at all of the states in the Midwest to determine which states had the most favorable laws to allow outside foreign investment and ownership of farmland. So my question to the panel is really twofold. Number one, how aware is the ag banking community of this trend and movement by nation states? And number two, do you think it will have any tangible impact on farmland values in the United States?
Speaking of things that keep you up at night.
Yeah. I'm not aware, Bill, of any real quantity of that kind of activity in the markets we serve today. But that's a very fascinating discussion that's taking place, and could it have a tangible impact on land values? Absolutely it could. And if you think about it, our population on the planet going from 6.5 billion to 10 billion in the next 20 years or so, that's a lot of new mouths to feed. And so those countries that don't have that finite resource we talked about, I can understand why they're having those discussions, and they're trying to figure out how to play a major role in controlling their own destiny, and it could contribute in a big way to that Silicon Prairie we're talking about and that growth in ag. It could be significant.
Well, and Nate, one of the slides that in the packet shows that 3.5% of the world is really good farm ground, and there are some countries that have almost none of it.
Right.
And so you can understand if that's their biggest weakness from a food security perspective, they would be interested in making an investment that way. Bob?
Yeah, I just can expand from, since Farm Credit Service America serves 4 states, I can just say that in the 4 states we serve, not only just South Dakota, that I'm not aware of that happening either. And we would be very concerned if that did start to occur, and I think it could have, depending on the magnitude, size, scope, and all those things, it could have some significant impact, especially in some pocket areas for land values. So, but it's something that we'll put on the radar screen, but I have not seen it in Iowa, Nebraska, South Dakota, Wyoming.
Bill, it's a great point, though. I mean, to my comment about thinking globally and acting locally, if we're not thinking globally, things like that aren't on the radar, and they can have a major impact locally in the markets we serve.
Good question coming from the audience, and again, folks, if you have a recipe card or you have a question written down, let's talk about that.
Well, Lucas, and just like with Bill, if they want to stand up and ask a question,
absolutely.
that's all right as well. Get more of a conversation. Go ahead.
Yeah, you don't have to be a former Secretary of Ag to pull that one off. So,
yeah, frankly, it's probably better if you're not.
Yeah, that's right. Ding. All right. A question about, and this is more of a question as I'm sitting here listening to the panel discussion this morning. When you look at the owner equity nationwide of folks in ag business or in farming and ranching actively involved, as ag lenders, you're working with folks who are looking to partner with you in terms of their operating lines of credit or their borrowing long-term debt. Can you talk a little bit about the folks that we don't necessarily see interfacing with you as bankers, but what's the equity position in the country look like? And for example, heard a stat last week that 60% of all ag-related land in the country is owned by women over the age of 65. Talking about specifically equity that's out there. We've heard some large numbers in the past, upwards of 90% equity in all of the ag economy. Would those make sense to you as the big picture?
Yeah, I don't know some of those numbers that you're talking about, but I can say that from an overall real estate debt, there's numbers of 36 to 40% of the ag real estate is debt-free. So there's a fair amount of equity in that. So you got to be a little bit careful with just looking at the equity number because of the recent valuation run-up, because it's going to impact that bottom line equity ratio significantly when you have land values that have doubled in the last 5 years. So while we watch owner's equity, and it's important to understand the equity piece, when we look when we analyze things, we look at working capital and capacity much more stronger than we look at overall equity, because equity can be driven by revaluation, which is inflation, if you will, that can impact the bottom line of a balance sheet, but maybe doesn't necessarily increase the capacity to service debt. So equities have improved. Just a simple answer to your question, when we look at our portfolio, there's no question that our owner equity position portfolio-wide has improved.
You know, I'd comment on the stat where you mentioned 65% of land is owned by women over the age of 65. I don't think that's a unique trend to agriculture. You know, we've got a tremendously large baby boom segment of our population out there that, you know, that owns a lot of assets, that have a lot of wealth, and that's going to transition over a period of years here, and that's not a new phenomenon. We've been talking about that for some time. That's a stat that kind of just highlights an example of that. You know, widowed women that own a lot of this ag real estate, and what's going to happen when they pass that on to their children? Are their children going to want to remain in agriculture, or are they going to want to turn it to cash, and what kind of land sales and is that going to create? And some of those trends will play out over a number of years in the future here.
Okay, thank you. We have a question from the audience.
And then after this one, Lucas, we'll do another presentation or two and then open it back up to questions.
All right, thanks. Here's the question.
Collectively, you all talked about the importance of animal agriculture, and it's important to a lot of us in the room. And yet we're seeing an exodus, particularly in small dairies and cow-calf operations, other parts of animal agriculture. People are abandoning their livestock operation to be strictly grain. And if we collectively agree that's not good, what do we think would be the most important thing from your vantage point that we could do to bolster animal agriculture in South Dakota?
Get the profits up. You know, I mean, that's the limiting thing. If you can, you know, dairy went through a wicked decline in the price of milk. Hogs, I mean, that was really tough for a while. Feeding cattle right now, there's the numbers are good, but to get people to continually do it, they need to make money at it, and we get that right price combination. Commodity prices, I mean, when you feed corn right now at this level, that's kind of hard to make a lot of money on livestock.
Yeah, unfortunately, agriculture is impacted by economies of scale significantly. And I don't know if any of us up here have the ability to change that. It's just the way it is. And so we can look at those opportunities, but economies of scale in those kind of industries have an impact on the ability to survive because there's limited profitability, which allows for a limited capacity to serve debt. So they have to be, if they're in small economies of scale, they've got to have minimal debt to survive. Because we all know what it costs to live, and we know what it costs to send our kids off to school, and some of those non-farm income that's usually associated with those kinds of operations, that non-farm income is usually eaten away by just plain living, because it takes money out there to do those things.
Steve?
Another thing that has to be considered is the labor pool, the labor force, finding those people who are willing to go out and work in the dairies, work in the livestock. You know, the labor pool itself is an issue. It's a little easier to find someone to go out and drive this nice equipment around than it is to get somebody to get up in the middle of the night and go check on a cow. The labor pool is definitely an issue.
Boy, that we could hardly ask for a better segue into our third question, which does deal with the labor force. And we're going to have Bob Schmidt be the lead respondent on this one. Bob, labor force, not just the type of work that people are looking for, but also the age of those folks currently in the ag sector. I mean, talk to us a little bit about how we resolve those concerns, those problems, and of course that means ultimately getting more folks and younger folks involved. Go ahead.
Good question. It's an interesting challenge. It's something that I've been thinking about. It's been on my radar screen for the last couple years, and it's really a twofold type question. And so it's we're looking at it from two responses. One is from a from an industry standpoint. How do we attract individuals to come be in the ag lending field? And the other part of that is how do we attract our youth to come back and be in the ag production side. So that's kind of what we'll talk about, and I may swing back and forth between the two, but they're both interrelated. It's the attraction to the ag industry. And so yesterday I was intrigued. I was listening to part of that roundtable that we had, and when they got through, when the key individuals got through with their, I think they came up with 7 key challenges for the state of South Dakota. One of them was bringing youth back into South Dakota, into the industry, into the ag industry, either on the lending side or on the production side. It didn't matter. So there was a breakout group, and so I thought, well, I'll sit in and listen to that breakout group, because when they resolve this, I'll just tell you the answer, and then we'll be done with this part of the presentation. And unfortunately, they didn't have any specific answers, and I don't either, because it's going to take a process to look at how do we bring this aging workforce that's slowly moving out and fill it with succession to fill those positions that are in there. So one of the things that I looked at when I saw this question, I said, how does Farm Credit Service America look? And we have a pretty good scope in South Dakota, and I assumed that our scope would be maybe mirror some of the banking industry. So when I looked at that, it was kind of alarming to me. I probably shouldn't have done the analysis that I did, but you can see it in the numbers here. But I'll just go through a few of them. And one of them that probably scares me the most, and if there's anything that I lose a little bit of sleep about when we talk about that question, we have 60 financial officers in what I lead in South Dakota. And our average age we have 19 of them, which is 30% or 33% of them that have over 30 years. So if you look at that group of 19 or 20 financial officers, they have the most significant industry knowledge, they have the most expertise, they have all the intangibles that are very difficult to transfer to a younger generation. We can teach young financial officers how to fill out balance sheets, and we can teach them how to do cash flows, and we can teach them the X's and the O's of the business. But the intangibles that are out there that you learn over financing during the 80s and financing over a long period of time, and some of the rocks that you got to kick over because you kicked one and you know you better kick another one, and we're going to lose a bunch of that. And so we need to be proactive. Our company, I'm talking about us, we need to be proactive more so today than we ever have been in trying to fill that gap to replace those. So it's something that's important to us. Another piece that stuck out to me is we have 9 certified appraisers, and I believe there's around 50 or so in the state of South Dakota. And of those 9, 5 of them are at retirement age right today. And that you may look at that and say, well, why is that such an issue? Well, the certified appraisers, ag lending requires a significant amount of understanding of valuation. And we use that information on our chattel inspections, on our real estate inspections. If we have any type of litigation, we rely on that certified appraisal to do those things. And if you look at that process, to get your certification, that isn't just something like, okay, today I go to school, I'm going to be a certified appraiser, and then I'm good. You have to follow through. There's various schooling, there's tests, there's amount of appraisals that you have to complete. It's kind of an apprenticeship, so it's something that you just don't say, okay, today I'm one and tomorrow I'm going to be another one. So it's something that we have to work diligently, and I think the whole state has to work diligently on trying to put together appraisers they're really important to the ag industry. So that's something that I looked at. The average age, again, when we're talking a little bit about on the production side now, the average age, if you look at the census from 1997 to 2007 of our producers is from 52 to 56 years of age. And one that's interesting, the number of farmers, or let's say producers that are under 35 has decreased in that same window from 3,800 to 2,300. So we're not seeing the entrance of young and beginning farmers into production agriculture. They're not coming back. So that's something that the roundtable talked about, and something that's an industry challenge for all of us to look at on that piece. So again, when you tie into what's going on in the farm size, and this is what correlates with the other piece is if you have GFIs of GFI is gross farm income. If you have GFIs of greater than 500,000, from the 97 to 2007, that average farm size has gone from a little under 1,000 acres to right at 2,800 acres. So our farm size is getting bigger, which we understand, and our number of producers is getting less, and our number of new, young and beginning, we call entrants into that farming segment is not occurring to the level that we'd like to see it. So there's some challenges, and we understand with the input costs, the amount of capitalization that it takes to enter the farming industry, it's very difficult. And the state of South Dakota has some beginning programs, Farm Credit Service of America has some beginning programs to help young farmers get started in operations, but it still takes a helping hand, a significant helping hand to assist them into that process. So it's a challenge that we have. The good news I looked at the Department of Labor and looked at what is the census. Where is it? You know, we have 800,000 people in the state of South Dakota. Where are they from a demographic standpoint and age? And there's around 190,000 between 18 and 34. So there's a pool of people. That's where this would come from, either from being a lending perspective or back into production ag. That's where this group would come from. There's a nice pool of people there. The challenge you have, and we talked about it a little bit earlier, is you're competing against non-farm income, and you're competing against disposable income. And usually a young producer has limited disposable income. They even have limited income, but they're competing against that job in town that gives them immediate disposable income and maybe a different lifestyle that Steve mentioned too earlier on this. So you look at it, and I was kind of shocked, 43% of the population reside in either Rapid City or Sioux Falls. Not a bad thing, just saying that's where it is. So when we compete out in, we have an office in Mobridge, South Dakota, and we have offices in some smaller locations, and when you're trying to attract someone to work in those, some of those rural environments, they have to have a different mindset to typically want to do and come and be employed in some of those areas. So that's a challenge that we look at. So when I looked at, and I'll talk about it in a minute, but those are just issues that we talked about, that I looked at regarding this whole process, is where is it? So some of the solutions that I just thought about that would be, in my mind, that we need to stay attractive with is, the first thing that I thought of is the state of South Dakota needs to remain a tax-friendly state. And as the challenges that all these states have with their growing deficits and the budget issues, and we know that some of these states are going to incorporate additional taxes that's going to put a burden on those residents that live in a particular state. I have two daughters. Both are in the medical field, and my youngest one is down in Creighton, and she's about a year or two away, and she's talking to me. Last time I visited with her, she's talking to me about, she doesn't know where she's going to live, but she's talking to me about, Dad, what state is more tax-friendly than another state? And she's a 26-year-old girl that I think a few years ago, probably that wasn't in the equation on a lot of people as they went out and looked for employment, but I think it's going to be more of an issue as some of these states incur a significant amount of taxes, and so South Dakota needs to make sure that they stay very tax-friendly to attract that potential employment. The other thing that I think is, from an industry perspective, is we've had some great exposure in the farming sector. Our farming operations have, we just talked about it, they've gained net worth, they've gained general farm income, they've shown more profitability, so there's opportunity to attract young farmers into operations, and they can actually have disposable income, and they actually can live a life that's more vibrant than it is in where it used to be, where it's a way of life, and in 20 years from now I will have a significant amount of equity. Because again, if we're going to compete against non-farm income, that non-farm income hits that balance sheet immediately versus something that's promised or gained over a long period of time. So that's something that I think is a positive impact because of what we're seeing in our ag sector. Also, all of us up here have had to increase our compensation packages. We've all had to be more aggressive to attract employees. So we've all done, I look at our employees get, as a matter of fact, I looked at probably 5 emails last night of a competitor looking at our employees and offering them some opportunities, and we have to make sure that our compensation packages are in play, they're right where they should be, and they're providing the type of compensation that other competitors are doing. So that bar's been raised, and that's a good thing and good way to attract things. But another key thing is the technology. The younger generation is very used to. They live with technology. They've grown up with it. They're used to it, and us in the banking industry, I think we've been a little slow to adopt to the technology, but I think all of us up here are moved on a more rapid pace to increase our technology. We use smartphones, we use laptops, iPads, we have automated underwriting, we use wireless technology, all things that when you interview someone that's just out of college or just starting, they're all very familiar with all these things. And they want to use that information, and they're good at it, and they can help us be more efficient in the process. So we look for those kinds of opportunities to provide technology to attract new employment. And then the only other thing that I have to add, and I'll let the other guys add anything, is we need to continue to be aggressive, and each individual company, as far as attraction, needs to customize their own processes, how they want to attract it. If that means spending more time at state colleges, getting interns, getting some exposure into going to talk to different classes as to what we have to offer. We have an interesting example here. One of our younger financial officers went up to South Dakota State. She's a graduate there, and visited with one of the Ag Econ classes. And I was in an interview about a month ago, and the young lady that we were interviewing said, we were asking her why she was interested. She said, well, you had one of your employees come and talk to us about Farm Credit Service America, and she said, I was so impressed with that, I thought I should come and at least talk to you guys and potentially interview with you about a potential job there. So we maybe underestimate the impact that has to that younger generation, but we need to continue to do those kind of things to continue to attract the youth, both on the lending side and on the production side. So I'll quit here, Dusty, and turn it back to anybody else.
Good. Yeah, go ahead, Bob.
One of the things with when you mentioned the generational difference, you know, the baby boomer generation, we were patient as long as we acquired things. And you said before, there's 75 million baby boomers, there's 57 of the Gen X's, and 75 million of the Gen Y's. But they don't have that patience. We need, for ag bankers, ag lenders, we need to pull from a farm pool. And that's where we came from, but we don't have that anymore. We just don't have the population out there with young people that have a vocation. And for us as lenders, ag banking is one of the last places that we have where it's relationship banking. And you can't teach experience. You can't teach feeling. You know, you have to experience something in life before you can help somebody, and it really helps if it's ag experience.
You know, it's a challenge for our industry. It's a challenge for all of us, and I guess I'd challenge all of you out there that are producers. Are you doing succession planning? Are you working with the next generation? Are you growing them to have the experience they'll need to someday run your operations? You know, at First Dakota, I can speak to us, and I feel fortunate to be where I'm at because we started planning for this a long time ago. And today, our average age of our ag lenders is 40. And I think if we compare ourselves to most of our peers, we've made a lot of progress in planning for succession and having the next generation of ag lenders in place. But there's a healthy balance there. You can go too far. We don't want to have an entire team of ag lenders that have 5 years of experience because they haven't seen a run-up in interest rates. They don't remember the 80s. They don't have some of those needed experiences to be successul. And so it takes a healthy balance. We're working hard to do that. I'd encourage all of you in whatever you do to be doing the same. And it takes time, and you got to start early, and you got to get after it.
You know, Nate says it very well. Succession planning is truly the key, whether it's in our industry. We all face similar situations, as these gentlemen have both said, and we started the same process. We've developed those programs to develop these young lenders in our industry. But we also ask you as producers out there, do it for your farming operations, do it for whatever ag business you are in. Succession planning is the key to our future.
Yeah, succession planning is really important. Is it easier in the ag banking industry because you've got folks who care about ag, they want to be a part of it. Maybe they don't want to have the lifestyle of getting up at 3 o'clock in the morning to go, make sure that, they go pull a calf if it needs to be pulled. But boy, they like doing this because they can help folks be successful. I mean, isn't it a little easier to do it in the ag banking and sort of the related financial industries than it is to actually get somebody out on the farm, out on the ranch?
The barrier to entry on the farming, and Bob talked about it, it's capital intensive, it's costly, it's hard to get somebody that's young and doesn't have a lot started in that type of a business, but at the same time it needs to be done for the health and long-term longevity of our industry. I think the 80s had lots of impacts on our industries, but one of the unfortunate impacts it had is it taught a lot of us to discourage our kids from coming back to the industry. And, we're working through that now. And today, I think we're at kind of an impasse where we really need to tell folks about the success of agriculture, the profitability in agriculture. It is an opportunity for young people. And we need to balance telling that story with the impact that message has on maintaining a safety net, a farm bill, and all those kind of things that are out there politically. But definitely something we need to work hard at.
Well, it's interesting you mentioned the 80s because I thought in Bob's data that sort of, really stood out. You look at the number of young farmers and how that really dropped precipitously in the 90s. Well, wouldn't those have been a lot of kids that would have grown up in the 80s seeing how bad things got, and when they had an opportunity after going to school to come back and be in production ag, they thought, boy, forget that. There were too many nights when mom and dad looked miserable.
And the banker was a bad guy back then, too. So they didn't want to go into the banking industry. Just a few years ago, talking to college students, nobody felt the students didn't feel there was a future if you started in banking as an ag banker. And what we tried to show them across the state of South Dakota, just about all the CEOs and presidents of the banks were former ag lenders. There is a career path there. You just got to get them interested.
Yeah, it's a great career path, but the challenge we have is finding and attracting them to the industry, because it's not perceived as that. But I do believe as agriculture becomes more, we have more exposure in agriculture, that's going to help the growth of production agriculture, and it's going to help the growth of ag bankers. I really believe that's going to happen. So. But we have to be diligent in our process, and Nate's challenge is excellent. We have to look at succession opportunities internally, and we have to challenge the producers to look for succession opportunities, and we have to be more flexible and be willing to push that envelope a little bit when we see that opportunity to help a young individual get into production ag. And there's some challenges in doing that, but we have to look for those opportunities to do that.
Well, I've got a few more questions, but this may be a topic that raises some interest out here. So, any questions out in the audience? Yeah, we've got a hand up in the front here.
Okay.
Come on, Lucas, let's get a little run. Let's get a little jog going.
Oh, you know I will.
Thank you. Dan Little with DairyNet. When you're talking about succession planning, and we touched on this a little bit, bringing experience into the industry, especially with livestock. It seems to me that some of the experience is as much of a concern to us as it is, the past of not being profitable is tainting what we look at going forward. And I'm wondering, if you looked at ideas of bringing together maybe more management boards, ways that we can move experience from one generation to the other within a business so that we could leverage some of this real estate money into operations, because what we really need is to improve the efficiency invest some of this into the livestock operations so we can have more efficient operations and yet not have the risk go out of control. Have you looked at any models like that where we could start to change a little bit on how we evaluate and work with management?
You know, one thought or suggestion I'd throw out there, and we've talked about it some in the past with our producers, is do you have your own board of directors? Do you have your own group of resources? You know, just yesterday I was talking with Dan Noteboom, implement dealer from the Corsica area, and he talked about a G20 group that he's a part of that is other implement dealerships around the Midwest and even down into Texas that meet on a regular basis to compare notes on what are the best practices. Those kind of things can be tremendously valuable. And so to a family farming operation where the succession is grandfather to son or grandfather to grandson or whatever the situation might be, that outside influence can be very healthy and very important to that transition. And if you form that group of resources, well, I'd encourage you to do that. Advisory boards, if you might call them, you know, all those things just have a tremendous amount of impact and value.
We're working on right now what we call a little bit of twist to what your question is, but it's a network group by either commodity segment or GFI or whatever. And so if we can align those groups together throughout the 4 states, it isn't just South Dakota, but it'd be by a particular commodity group, and have those people aligned and network together, that would be an excellent opportunity to put the challenge to them to try to provide that type of expertise. So that's an excellent opportunity, but we're looking at some networking groups to provide that opportunity.
Good question. Others?
Yeah, a question, it kind of follows on what we're doing, and I guess the question I have, do you think that we need a change in the structure of farming? You've mentioned that size of farms have almost doubled, and I see it as almost an impossibility for a young person to start from zero and get anything and not live a miserable life and die wealthy. And also, I see a problem many times of one generation not wanting to pass soon enough for that second generation to get the new knowledge, new technologies. And I'm thinking, as large as our industry is, as our farms have become, there's no other industry that every generation almost starts over. And do we need a different structure in agriculture so that that succession can happen? And we can also, I think, divide duties within those in a business structure much more than many do. And I guess I look for opinions on that.
I could just throw something out. I don't know how we would change the structure, but if you could change some of the tax laws so it'd be easier to pass assets, you might have an opportunity to increase transferring of that wealth without it going somewhere else in a quicker fashion. So, but it's an interesting question you have, because economies of scale are so important to profitability, and I don't want to say bigger is better, but in many cases, if you can run across more acres and you cut that cost per acre down, your net margin increases, and so there's a real propensity to continue to look at size, which improves overall efficiency, especially with new technology than all the things that are occurring on the capital side of things. So it's an interesting balance to bring someone new in that doesn't have that ability or capacity to even to get in that game.
Another thing, the people we're talking about, the generations that's ready to retire, they're successful because they were the most independent group of people. And it takes a long time for them, after they've acquired all this, to start talking about moving it over. The next generation and the one after that, I don't think that will be as big a concern. But the age that's retiring right now, it took them a long time. They went through a lot of tough times to get what they have. And it's hard to part with it.
Jim, did we get you answered? Sure. I mean, if the size of the operation can't change because the economy scales are such a strong major force, I mean, can there be things done within a corporate structure to make it a little bit easier for the generations to share management, share ownership?
You know, a comment I'd make to that is, you know, the global trends are the global trends, and they're part of what's driving these economies of scale. And I find it hard to wrap my head around how we change that. How can we reverse that? I don't come up with answers there. And so what I come up with is what I said earlier. It requires more and better planning than ever. And that succession planning and that getting started early. You know, the examples that trouble me the most is that that farmer that won't plan for that transition until they're in their 70s. You know, it's too late. You know, you need to be planning for that well prior to that and growing that next generation of your ownership of your farm.
But I think your comment about LLCs and in the corporate structure, there'll be more of that all the time going forward.
Hold on here, Jim. Go ahead, Jim.
I said, I think, do we need a structure where you continue the management? Because on a succession, it seems like every time there's a succession, there's a certain start over, a certain reversal, a certain loss of momentum of that good business. And I don't see that in other industries. Do we need a way that it doesn't succeed from father to son, or you know, that it becomes a business structure that you just change management like you do in your banks?
And then maybe a relatively quick answer or two, and then we should move to our last question. Who's got an answer for Jim?
Jim, I guess my thought is I feel those structures are there today if they want to be used. I mean, you know, there's corporate structures, there's LLCs. You can run your farm that way. You can find that management labor if you have the size to do that. So I have a hard time coming up with a new way, a new structure that helps that, other than just good planning.
So it's more about better utilization rather than an invention of a new approach. Okay. Let's turn to our last topic, which is risk management, which we've sort of talked around a number of times throughout the other questions. But Steve's going to be our lead respondent on this. And Steve, what are some of the better risk management procedures that you guys are using in your shop, and what are some of the better risk management procedures that you're seeing with folks that you're doing business with?
Okay, well, we'll start with, you know, certainly risk management is key to the success of any operation, but we'll start with the techniques being used in the ag finance. Believe it or not, people, bankers love numbers. You know, it's hard to believe, but we do love them. You know, management techniques, I don't know that we've changed so much, but, you know, maybe it's the way we view them now. You know, we've taken a different view. These farming operations, they're becoming more and more technical, and so is our approach to lending. You know, our underwriting standards, you know, we've stepped them up. There's no question about that. The typical ratios we had once used, we've adjusted them. You know, we talk, lenders in the industry, we talk a lot about the Sweet 16 ratios. You know, I won't touch on every one of them, but we're going to touch on some of them. And we've also started implementing some new monitoring ratios into our underwriting standards. But really the ratios we continue to look at, you know, the debt to equity ratios, the debt to asset ratios, the liquidity ratios that we've been using, you know, satisfactory previously. If you were 1-to-1, you know, we were comfortable with that. Well, believe it or not, in this day and age, we'd like to see them a little bit better. You know, one thing we do monitor on a regular basis, we've talked about the increase in real estate and what's going on, is we're looking at more earned equity changes, where we actually take a stable valuation on the real estate or the livestock, whatever's there, to determine at the same time what the equity change has been in the operation. But with all due respect to, we also prepare actual market value statements using realistic valuations, because we do realize there's certainly value to the increase in the assets. Newer ratios we've introduced in recent years, we've taken some from the commercial side. We're implementing a debt service coverage ratio. We like them to be in the 1.25% area, but we borrowed that from the commercial side of things. And another ratio we're watching more and more is the operating expense ratios of these farming operations. We like them in the 65 to 75% area. You know, and we realize they'll be significantly higher in certain cattle feeding operations, but those are a lot of the ratios that we use. You know, you're starting to see in the industry, we're starting to put some conditions and some covenants out there on different issues. You know, a lot of these are case by case, but in some instances, we're actually requiring certain financial ratios and limitations. We've actually established a borrowing base for some operations, where we will lend a certain percentage of their inventories that are pledged. And in some instances, we're now doing capital expenditure limitations. Anything these operators do purchase, we do require a certain dollar amount that the banks approve it prior to going on. A lot of what we talked about earlier was the land valuations and what's taken place there and how we approach that. I know Bob touched on it a lot as well, but the loan to value on real estate, normal, we used to be 75% loan to value and we were comfortable with that. Today we're in 65% loan to value, and in some cases, perhaps even, it's a case-by-case situation, but in some cases even less than that. So, the bank side of it, we've certainly seen change, but a lot of it not new, but maybe the approach that we're taking and the view that we're taking. As far as the producer side of it, here's certainly an area that there's more and more opportunity all the time as far as managing risk. A key phrase that we like to use all the time, you really need to know your cost of production and plan accordingly. Nowadays, we're seeing producers prepaying their inputs for next year already in the fall of this year. We're seeing it more and more all the time for a number of reasons. Some cases, it's better pricing. Some people are actually doing their tax planning. We've had some very successful years, so it's part of their tax planning process. But the fact that they know the hard costs going into next year's planning season so they can start marketing it accordingly. We do encourage these producers, and I'll emphasize the word encourage, that they do exercise, if they're exercising this option, that they do go out and lock in 25 to 30% of their insured covered bushels at the time they do these purchases. You're locking in your cost. If you see an opportunity to lock a profit in, why not do it on a portion of it? But as far as other opportunities, marking options that are out there, talk to your local elevators, your ethanol plants. The old ones are still there. The cash sale price, the DP, the delayed pricing. There's also target prices out there. There's a number of price contract options, fixed future contracts, hedge to arrives, basis fixed contracts. I've got a number of them in there if you looked at your handouts and what they involve. But a number of opportunities just through your local elevators and ethanol plants. But what was interesting to me in talking with both the ethanol plant and the local elevators, even in today's environment, only around 50% of our producers are actually utilizing this as a form of risk management. And we were talking about that a little bit earlier here as well. And part of that is there was a lot of farmers were very successful in recent years. They haven't had the need to do this, so it was surprising to us that the number is 50%, but certainly there's opportunities for those producers out there. Other things our farmers are doing, there's options and futures to help manage risk. We've got producers out there buying put options. They're selling call options. There's a number of common hedge strategies. I placed a couple of them in the handouts just for you to look at, but typically your put option, we view it as an insurance policy in case prices go down. Your call options, something you purchase. If you sold some product, it's an opportunity for you to purchase it. Purchase it for any additional upside movement in the markets. As I said, some common hedge strategies. People buy puts, and they hope they're wrong. It's an insurance policy as far as they view it. We can sell grain. We turn around, as I said, buy a call in the event that prices rise. And we get a little more creative. We've got people who are actually out there doing what we refer to as fences. They buy call. They buy a combination of puts and calls and just kind of fence it for opportunities to decrease the cost in what they're doing. We also have a number of producers who are actually starting to use the futures. They actually go out on the board and purchase futures positions. The problem that they're faced with is margin calls, and any of you who have ever received a margin call, it's not that much fun, but it's part of the game and it's what we do. But options and futures are certainly being used, we feel, by about a third of our producers in our shops, and talking with other banks here as well. It's something similar there, but certainly opportunities. Probably the most common risk management that people are using is certainly crop insurance. Why do farmers need crop insurance? They've got a huge investment out there. They need to protect it. The main source of protection is revenue protection. Where it guarantees an amount of revenue based on the farmer's APH. They can insure the insured part. They receive the higher the projected prices if a loss does occur. I mean, crop insurance is certainly key to a number of these producers. And as I said, it's probably the most widely used risk management tool in the industry, with probably 95% or even better. The last one I referred to, and you can see in your handouts, is something new called the weather bill. believe it or not, you can insure nowadays for weather issues. Total weather insurance. It provides insurance that pays out based solely on a specified weather condition. Works with the farmer's federal crop insurance. There's a number of coverages, a number of perils, starting from anywhere from excess rain during the early season in planting to cold growing seasons that we've seen. We've experienced both of them this spring. Drought, let's not talk about that one too much. Heat stress, early fall freeze, excess rain at harvest times, just a number of different perils that you can actually insure. And we do have a number of producers that are dabbling in this just to kind of get a feel for it, to see how it could help them manage their operation a little bit better. As you can see, I mean, there's just a number of risk management tools out there, and I've just touched on a few of them. But the key to all of it, the key to them to be successful is, as I indicated earlier, knowing the cost of production and determining your profit margins. Now, I like to use a comment from one of my old mentors just to wrap my side of this up. I've never seen a producer yet fail by taking profits. So,
Steve, how widespread is the use of the weather bill? I mean,
the weather bill, it's relatively new. It's been around since 2006. We're just starting to see more and more of it. We were first introduced to it probably a year ago in our market, but we are starting to see it, and with the weather the way it's been, we do have a number of producers who are, if nothing else, putting their toe in the water to get a feel for it. There's an opportunity there to protect the top side of that your marketing plan, so there is some use of it.
Comments from the panelists on what Steve walked us through.
Just a short comment when you talk about risk management and changes internally that we as lenders have to do is a few years ago, not that long ago, I would say that we would typically provide operating capital, and during the winter, and you'd have your turn, and production would come out, and you'd refinance that. Nowadays, we typically have we're financing 2 different cycles, and we're doing that because the producer is looking at opportunities to fix some of the input costs today for next year. And so, if you want to be a reliable lender and be one that's their partner in doing things, you have to be flexible enough to look beyond just what's going on this year. You have to provide the capital for this year and also look at their operation to see what capital you're going to be providing for the following year, which is 12 months away. So that's something internally that, a few years back we weren't doing, but now because of the risk management that we're asking our producers to do, we in turn then are asking ourselves to be more flexible in providing that capital on multi-year terms.
And that's one thing, but with the producers nowadays having a stable of things that help mitigate their risk, for us in ag lending, we have some fantastic tools to mitigate our risk. And as they're starting to look at our banks and calling it a concentration in ag credit, my argument is we have risk management tools. We can mitigate the risk with crop insurance, this weather bill thing, the forward contracting of commodity prices, locking in input cost. Like you said, Bob, we do now have customers that have this year's line of credit in the fall, extended, tied to grain sales through the next July, but we are ready in November, December, have next year's line of credit all set up, ready to go. And they've got their house in order. They can take advantage of huge discounts in the fall. We know why the suppliers are doing it, but we're able to help them out, and like I say, it mitigates our risk considerably. We don't have that tool for other financing and other businesses.
The only other comment I'd add to this risk management discussion is it is very much a case-by-case individual effort. And so what works for your operation in risk management might not work for the next. And what works for our bank might not work for the next bank. And so it's very important to look at your case, identify your biggest risks, and then manage those risks the best you can.
We're getting close to the end of our time, but let's take a question or two if folks have them.
Thank you, Dusty. One of the questions that came up was still about the young farmer and rancher discussion. And question handed off at 65% loan to value, isn't it almost impossible for a young farmer to get in? And I know we've talked about it, but if you are a young beginning farmer and you have to put your balance sheet together and you're looking at a loan to value of 65% or whatever. Specifically, what are the things that you look for when a young beginning farmer comes in? Is it really impossible with just coming in on their own, or is it necessary to have that second and third generation support?
If it's a really great credit, a person that you worked with before and they're now expanding first time maybe on a piece of real estate, we've utilized the FSA Guarantee Program or the FSA Young Farmer Program that helps the bank finance individual in partner with FSA. We've used that quite a bit.
Yeah, I would just say that we have, I don't want to say reduced underwriting standards, but we do have ones that are maybe not quite as strict for that segment, which would fall into that category of young and beginning. And we look for opportunities to try to maybe stretch a little bit when it's the right person, just as Bob talked about, with the right mechanics behind it and those kinds of things. So we look for those opportunities. There are some regs that don't allow us to do certain things, and so there is so much as far as the level we can go to. But we do have a program in place to try to help that young producer.
As Bob had said, the FSA program is certainly an option, and we've utilized it a number of times, but an issue with the FSA guarantees and whatnot is their funding source. It's not always there. It's not always available at the time we need it. So we've had to get creative in a number of issues to try and make that work. But one thing that would help if we could guarantee that source of funding on a regular basis through FSA.
And that's one thing in ag financing. We live each farm bill. You know what I mean? Every farm bill throws us a whole new set of rules, just as it does for you producers, and we have to adjust and modify around that. Well, Washington keeps me awake at night too.
We started the session by me telling a couple of banker jokes, but I think in reality we understand that you simply cannot have a successful South Dakota agricultural sector unless you've got folks who are willing to be financial partners. And the folks up at this table certainly have a great track record of helping to work with others to make them successful. Let's give our panel a round of applause.